Are you a business owner looking to increase your bottom line and benefit from additional insurance coverage? Regulations allow your business to insure itself, essentially forming your own insurance facility that insures your parent company, also known as an insurance captive. This is ideal for small to mid-sized businesses. Micro-captives are not meant to replace your current business program, but rather enhance your risk financing approach and complement your current coverages. Many business owners choose to place their deductibles and retained risk into their captives and use them as a vehicle to insure risks that are excluded from their current insurance coverage. This is one of the biggest benefits to starting a captive, the ability to create your own policy that is more suitable and reflective of your business rather than the generic policy provided in the conventional marketplace. You may also insure against general enterprise risk, reputation risk, and cyber liability. Also, there are less costly premiums associated with this arrangement. With a captive, you have the ability to pre-fund future losses with the aid of actuarial forecasting. If losses don't develop, you have access to your profits. That's the beauty of self-insurance. Instead of just your insurance carrier profiting when you don't have expected losses, you retain the dollar amount from premiums paid as a deductible expense in your own capitalized facility. With a tax-leveraged micro-captive, your business can allocate any amount up to $2.2 million into your captive. A captive is a separate legal entity from your parent company, meaning that the monies you allocate to the captive are protected from any liabilities the parent company may generate. Let's use this chart as an example of a construction company with $400,000 in current insurance expenses. The company is in need of additional insurance to protect their balance sheet from the possibility of liability incurred from their operations. As you can see on this chart, by leaving the $400,000 in cash versus putting it into a captive, the business is incurring the same amount as the captive in insurance losses, $40,000, by risks that came into play during the year, along with paying a combined $149,400 in state and federal taxes, and is left with $210,600 from the original $400,000. Now, if they decide to put that $400,000 into their own captive, they may save $100,000. The company starts by paying themselves or their own insurance company a $400,000 premium, which may qualify as tax-free. The business, again, had to pay the same amount in incurred insurance loss, which is $40,000. Instead of paying taxes, however, they need to only pay operating expenses, which in this case are $49,400 in total, which leaves the business with $310,600, thus saving the firm $100,000 in comparison to not putting that money into a captive. So, what are these operating expenses? They are established from the operation of the captive business, such as monies paid to a captive manager, actuaries, and your accountant. A good question to ask is, why not start a captive? You could be inefficiently managing capital by not doing so. You may think this is too good to be true, or that it's too time-consuming. But in reality, with RPM's turnkey approach, a captive can be easily formed.